Welcome back to Real Estate Beast, the podcast where we dive deep into the complexities of the real estate market. I'm your host, Michel Kmiotek, and today we're tackling a topic that's on everyone's mind, affordability. More specifically, we'll be examining the recent explosion of property prices in the western regions of the world and what this means for prospective buyers. So, let's start with some historical context. Many of us have heard stories from our grandparents and parents about how they could buy a house for what seems like a fraction of today's price. It's true. Back then, real estate was much more affordable. But what's changed? To understand this, we need to consider several factors. Post-World War II, there was an economic boom. Home loans became more accessible and suburban development took off. Property prices were relatively low back then, and home ownership was within reach for a significant portion of the population. Interest rates were high in contrast to recent standards, but the monthly mortgage payments were manageable for most households. Fast forward to today, and we see a starkly different picture. In many Western cities, like across the US, Canada, and Europe, property prices have skyrocketed. Data from various sources indicate that over the past decade, median home prices have increased by over 50%, outpacing income growth by a substantial margin. Let me point out once more that real estate is unique. No two properties are exactly the same, and this uniqueness adds to the complexity of pricing. For instance, real estate markets can't be neatly summed up by simple supply and demand rules. They are intricate ecosystems with numerous actors influencing outcomes. One of the most significant players in this ecosystem is the bank. Think about it. You don't really buy a house, the bank does. When you sell a house, you're essentially selling it to the bank, not directly to the buyer. And when a developer wants to build a new project, it's the bank that funds it. The bank is the silent partner in almost every real estate transaction. Here's how it works. The bank provides a mortgage, a loan secured by the property itself. This mortgage isn't just a financial tool, it's a commitment. The bank essentially buys your future income by shackling a mortgage to your household earnings. You don't just buy a house, you buy a long-term obligation to pay off a loan, often spanning the entirety of your working career. Given this framework, the traditional supply and demand model falls short of explaining the real estate market's dynamics. We might have a situation where supply meets demand, yet transactions aren't happening. Why? Because of the cost of borrowing, the interest rates. Interest rates play a crucial role in determining affordability. When interest rates rise, so do monthly mortgage payments. This can push the cost of home ownership beyond the reach of many potential buyers, even if there are plenty of houses available and willing sellers out on the market. Currently, with the interest rates climbing, we are seeing a significant impact on the market. Many people find themselves unable to afford the monthly payment required to service their loans. Despite a supply of homes and demand from buyers, the number of deals being made has plummeted. Rising interest rates have increased the cost of monthly payments, making it difficult for many to qualify for mortgages. This results in a stagnant market where supply and demand do exist, but transactions do not. So, what do we mean by affordability? In simple terms, affordability refers to whether a large portion of the population can purchase a given product. When it comes to real estate, this means that only a small fraction of people can afford homes. Affordability and market efficiency suffer due to this. Market efficiency in real estate is crucial. An efficient market is one where prices reflect all available information and properties are accessible to a broad range of buyers. However, when prices soar to levels only a few can afford, the market becomes inefficient. This leads to reduced mobility, higher rental demand, and often increased social and economic disparities. It's common to believe that for homes to become more affordable, prices need to come down. However, this isn't necessarily true. Banks aren't obligated to issue loans to everyone who wants one. Unlike a social contract, banks operate on a capitalist model. Their goal is to maximize profits from money they lend. That's it. This means they aren't required to provide loans to lower income families or to issue a certain number of loans each year. Let's be clear. We're dealing with one of the most capitalist industries in existence. A bank's primary business is making as much money as possible from the money they lend. They assess risk and reward meticulously and aren't in the business of altruism. So, what happens when banks tighten their lending criteria or when interest rates rise? Getting a loan can become incredibly challenging when banks aren't willing to help. This is particularly true in an environment where interest rates are high and banks are more risk adverse. So, how can potential home buyers navigate this tough landscape? The answer lies in creative financing. Creative financing can be a home buyer's best friend in a tight credit market. Here are some examples of innovative ways to finance a home purchase. Seller financing. In seller financing, the seller acts as the lender, allowing the buyer to make payments directly to them rather than to the bank. You're just cutting out the middleman. This can be a win-win, providing the buyer with the access to the property and the seller with a steady stream of income. Lease-to-own agreements are also another way to go. This allows the potential buyer to lease a property with the option to purchase it at the end of the lease term. Part of the lease payments can often be applied towards the purchase price, helping the buyer build up equity. Next up, co-borrowing. Teaming up with a friend and family member to purchase a property can increase your borrowing power. So if you borrow together, you have more equity in the property and you have more chances of the bank actually loosening up their lending criteria towards you. Then there's one that I really don't understand nor like. It's the crowdfunding. Platforms for real estate crowdfunding are emerging, allowing multiple investors to pool their resources to buy property. And this can be a way for individuals to invest in real estate without shouldering the entire financial burden alone. But to me, these are just vehicles that make the deal way more difficult for you to attain. Shared equity, on the other hand, is a way for an investor to provide part of the down payment in exchange for a percentage of the property's future appreciation. This reduces the initial financial burden on the buyer and aligns the interests of both parties. Difficult and something that you need to really look into before actually applying it. Then of course there's the government programs. I won't get into these because every country has a different set of programs to help their residents become homeowners. It's up to you to do your research and understand what benefits might be out there. In any case, while it might seem that high prices and rising interest rates put home ownership out of reach, creative financing can offer variable alternatives. Understanding and exploring these options can help potential buyers find a path to home ownership. Now, let's shift gears a bit and talk about the challenges of estimating property prices accurately. So, when I explain this to my agents, I always use an analogy. When an agent joins our agency, one of the most challenging tasks that they face is gauging a property price accurately. This isn't just a matter of looking at recent sales, it requires understanding the nuances of the market and the preferences of potential buyers. To help new agents grasp this concept, I often use the example of a Gucci handbag. Now consider this, a Gucci handbag has a certain price tag. However, not everyone will want to buy that handbag. Men, for instance, are generally not the target market for a woman's handbag. So, those are out of the equation. Among women, only a certain age group might be in the market for such a luxury item. Out of those, some will find a handbag too expensive, while others may never buy it regardless of the price, simply because of the brand. The same principle applies to residential real estate. When pricing a property, we need to find a price that appeals to the largest potential buyer pool. This means understanding that not all buyers will be interested in any given property. For example, if a house is located next to a railway, it won't matter how low you set the price. many buyers simply will not want to live there. The goal is to identify a price point that attracts the most interested buyers, knowing fully well that some buyers will be dissuaded by factors beyond price. It's about striking a balance and finding the sweet spot where the majority of potential buyers see value. Now, let's confront the controversial but important truth about affordability in housing. When we talk about solving the affordability problem, there's a hard truth we need to acknowledge. We can't make housing affordable for everyone. Just as not everyone is in the market for a Gucci handbag, not everyone is suited to be a homeowner. This might sound controversial, but it's a perspective grounded in particular reality. There are many instances where people are better off as renters rather than homeowners. Renting can alleviate the burdens of property maintenance, repairs, and the financial strain of homeownership. It allows individuals to live in homes without the responsibility of managing and maintaining the property. Now, I've seen numerous cases where home ownership was not the best option for individuals. Properties inherited by people who lack the necessary skills or resources to maintain them often fall into disrepair. Now, these homes can quickly fill with junk, become infested with mold and pests, and require substantial renovation budgets to prevent them from turning into total ruins. Consider this scenario. Someone inherits a home but doesn't have the financial or practical know-how to keep it in good condition. Without regular maintenance, minor issues can quickly escalate into major problems, resulting in costly repairs and a significant decrease in the property's value. This reality, to me, means that pushing for universal home ownership might not be the best approach. Instead, we should focus on creating a balanced housing market where both renting and owning are viable and respectable options. Ensuring quality rental properties and supporting renters with fair policies can provide stability and flexibility for those who aren't ready or suited for home ownership. So, as we discussed, the goals shouldn't be to make every person a homeowner. Instead, we need to create a diverse housing market that caters to different needs and circumstances. By recognizing that renting can be a more suitable option for many, we can focus on policies and strategies that ensure everyone has access to safe, affordable housing, whether they choose to rent or buy. As we conclude today's episode, it's clear that while we should strive to make real estate affordable enough so that a large portion of the population can enjoy the benefits of home ownership, we must remember that the market isn't governed by a simple supply and demand equation. Governments can't always step in to save the market whenever a shift happens. And we need to acknowledge that this is a complexity that plays out every single day on the real estate market. That concludes our podcast on affordability. I want to thank you for listening and hope that you tune in next time. If you have any questions or suggestions, don't hesitate to let me know. Remember to like, subscribe for more insights into the real estate market. Until we meet again, happy investing.